In this episode, we will be talking about all things loan rates, borrowing, when you should use your policy, what opportunities make sense to use it for, and when you should not. And with that being said, let's go ahead and dive in. Hey, Caleb, this episode came up and this content and idea came up mainly because we were actually having communications with a client, and he has a policy with us, a significant amount of cash value, and he also has a line of credit with his bank. And he's in the midst of looking at opportunities and figuring out, should he borrow from his line of credit? Should he borrow from his policy? Looking at interest rates. And he just was kind of, analysis by paralysis because he had options, which is actually a good place to be in. And so I thought it would make a lot of sense for us today to talk about, what should someone consider when it comes to an opportunity to be able to borrow against using the strategy that we preach and talk about all the time, specifically using whole life insurance, designing for high liquidity purposes. So with that being said, I'd love to hear your perspective. I'd love to hear you kind of take it from here and just kind of
Yeah,
jump into
yeah.
it.
I mean, we could. This is a great question. I think it's a classic oldie but goodie. I think a question we get a lot is when should I borrow against my policy? And another way to say that is what should I invest in? And we're really clear that we don't give investment advice, and so the idea of giving someone advice around when they should borrow sometimes is predicated on the activity that they're doing. And so what we're going to do in this episode is we're going to walk you through the mindset and the framework. And hopefully you can take this information and better apply it to your life from a paradigm standpoint. And it's just like, it's really important. I know when I first met R. Nelson Nash, I would ask him like direct questions. I was like the person in the comments being like, tell me exactly, like, don't give me analogies. And I always got frustrated with him because I'm like, I didn't ask about the story of Exodus. I wanted to know
Mm.
like about non-direct versus direct. And he's like giving me this Bible passage and the stories. But then as I reflected back, I'm like, there's really power in helping people rethink their thinking and helping them think for themselves. And a lot of times when you
So
just
good.
say, do this, do that, it's the same reason why AI could make us way dumber is now we just outsource all of our thinking, all of our creativity to Google or to AI. And so Dom, it's very, very simple at the end of the day when it comes to when I should borrow. And it's very similar to the same question of if my money was in a high yield savings account, when I should use my money. And we're especially talking about investing, but we should also talk about, liabilities, buying cars and all. And it really comes down to two things. It comes down to the activity that my dollar is going to be doing and what is it worth the squeeze? And it comes down to the risk that I'm taking by doing that activity. And very few of us do a very good job showing or like thinking about risk in any outside activity that we do. And then the first one is this worth it financially? Really easy to measure, which we'll break down how we do that. But the second one can be tricky. And then if you want to add the third part, if for like the A students, it's factoring in opportunity cost and saying, okay, maybe it's worth it financially, even when you factor in risk, but is the opportunity cost of me saying yes to this, meaning I'm not able to say yes to the thousand other things that I could be doing, is by me saying yes to this, what am I saying no to? And are those no's ultimately more valuable than that yes? That's
Mhm.
it. And we'll obviously spend the majority of our time together talking more through that. My hope would be, and I would love if someone commented this to be like, this episode helped me have a better framework of how to think about my life insurance when it comes to when I should borrow.
I love it. And what I'd love to do is find a way throughout this episode to maybe talk about a real life example of some sort of nature. It doesn't have to be like exactly to the T, but at least give a case study where we can talk about generalizations from either an opportunity that I've heard about or something that you've heard about, and be able to give ideation around like the framework to do so. So I think a case study along the way would probably hit the home
Yep.
Hit the hit the nail on the
Joel's gonna get
button.
really excited. He's our producer. He's gonna get really excited for me to publicly say this. Um, yeah, he's showing his face behind the scenes. You can't see him, but he's excited. What I'm gonna do this next year is we're gonna have a mini series of me using my policy for random things, and document the journey. And so this
Love
might,
that.
who knows what this is gonna look like, but I've realized that how cool would that be for me to show in real time, hopefully making money. I don't want to, or I lose money at your guys' fun expense, but it's showing people real time how you go through the process and how the math works. And that's one thing that has kind of been on the idea panel, but it's something that I think is going to be fun pieces of content to make. And people will firsthand be able to see how we analyze deals and how we go about things.
Amazing. I love it. I think that's going to pay dividends. Da-da-da, psh. Oh, well, pun intended. All right, let's go ahead and get after it. You got some fun drawing for us, Caleb?
Yeah, so before I get into my fun drawing, let me just share with you a part of a presentation I'm working on. And yeah, I'm going to share my entire screen here. And this is as we're thinking about life insurance, there's different type of people that will use life insurance. There's people that will use it for retirement. There's people that will use it for inheritance and maximizing their legacy. We're going to be talking to the person that identifies as an entrepreneurial investor. And how I define an entrepreneurial investor is someone that's either an entrepreneur or business owner, or is investing or wanting to utilize their time and money through the mindset of how would an entrepreneur invest. So that's what we mean by an entrepreneur investor. And so before we get into when does borrowing make sense, let me just lay this out. So you have somebody who's making money, who, if they're an entrepreneurial investor, they're probably saving their money in some type of account to be able to then deploy into businesses, investments, maybe real estate, or whatever they want. There's a lot of creative areas that you could use your money. And so the pros of a savings account is it's safe, it's liquid, it's convenient, and it has some growth. I put that as a yellow because it's got more growth than a checking account, but it's like savings accounts historically have not done super great. And then the cons is low growth, it's not tax deductible, it doesn't grow with tax deferred growth, and you have no creditor protection. So there's pros to a savings account, but then there's cons. Now, when we look at life insurance, you do the same equation. You're making money, you're putting it into an overfunded life insurance policy, which is maximizing the living benefits, minimizing the death benefit and all, and really trying to optimize the cash in the policy and as it grows and can be used. And you utilize that to do the same thing, buy businesses, invest in whatever you want to invest in, acquire real estate, do whatever you want. And when you look at the pros of life insurance, there's a couple more pros. If you just, and this is for anyone that follows us or watched our videos, like when set up and used properly, life insurance can be a very valuable, tool to have. And there's a lot of pros. And then there's cons, like everything. You don't get a tax deduction, just like a savings account. It takes a couple years to have more money than what you've put in. And this is this could be a problem for some people. Some people want access to every single dollar, and they don't like the fact that you don't have dollar for dollar access immediately. So the fact that you put in $100,000 and you only have access to 90 or 85,000 year one could be a turnoff for somebody. And so that is a con. And then the last thing is not everyone qualifies health wise. And we know we have people that haven't qualified health wise, but have gotten life insurance on their spouse, their business partner, their kids, their grandchildren, but that still can be a con because not everyone can actually get this. So, when we look at the benefits, we first of all, one of the big questions that we constantly get is why does it make sense to use life insurance why does it make sense to borrow for my life insurance? And I want to address this first, and then we're going to talk about how borrowing works. Is like a lot of times people are like, well, the rate of return, like my borrowing rate is higher than the rate of return I'm going to make in my life insurance policy, which for the most part is accurate. If your loan is, let's say, 6% and you're earning less than 6%, if you just looked at those two scenarios, it would not make sense for you to do borrowing. I don't care even the people that say compounding versus amortized interest, like factor in opportunity costs to that. If you're only earning 4.5% in one bucket and you're paying 6%, no matter how much gymnastics you do, that scenario does not make sense mathematically. And so someone might be watching this and being like, well, Caleb, aren't you just contradicting life insurance? And the answer is no, because we're just looking at competitive growth. We're not looking at all these other benefits. And so the question is, if all the other benefits still make life insurance less valuable than the borrowing rate, then you shouldn't do this strategy. But if life insurance with all the benefits are greater than the cost of borrowing, then you can say that you have beneficial arbitrage or benefit arbitrage. And Dom, you interrupt me anytime. I'm just going to keep going.
Yeah. The one thing that I'll just add to that is I think the arbitrage conversation really is only valid when you're trying to be like, oh, 4%, 4 to 5% growth, 6% borrowing. It's like, why would I do that? When you're talking about max loaning in a consistent basis, because yeah, if you're taking the full buckets on each side, the full growth is only getting 4 and the full loan amount is getting 6. Of course, like mathematically doesn't make sense. But if you're only borrowing like a quarter of the money at a point in time, if you had 100 grand and you're only borrowing $20,000 and you're only getting, 6% on that, that 20 grand is only like $1,800, but your 100 grand is still getting the full 4%. So you're actually making money in arbitrage. You're actually making 4 grand when you're only spending 1,800. So I think if you're looking at how to use this responsibly as a tool, there is still some arbitrage that could be had when borrowing if you're not borrowing the full max amount on a
yeah, but
consistent basis.
I hear what you're saying, but I feel like I don't necessarily agree with that logical
That's math.
connection because, well, no, it's not just math. You have to factor in opportunity cost because you're essentially saying, well, if you don't borrow at all, you still get arbitrage. Well, it's like, no, just
I didn't
because
say that. If you didn't borrow at all, you didn't get arbitrage. You make
I'm just saying
four.
I don't endorse what you just said because if you're saying if you have $100,000 in an account and it earns, let's say 4%, but you're only borrowing a portion of that.
Mhm.
Well, so there's almost like those two buckets that you're separating it in. But it still goes back to like if you have, even if I had $10,000 in something and only it was earning 4, and then like let's say this is a savings account that we didn't have to borrow, and I had $100,000 in a savings account that's earning a tax-free 4%, and I could borrow against that for 6%, or I could just withdraw it. Some people would say, well, you should still borrow against that. You earn 4% in your savings account, you pay 6, and then you could even say, well, the most of your money is earning 4, so you're actually getting ahead. Whereas I would just say, withdraw that money at 4%. You're missing out on 4% instead of paying 6, and then put that money back. So the matter of if you're only taking a $10,000 loan, it doesn't matter if I have 100,000 or $1,000,000. I still want to be efficient with the activity that I'm doing. Does that make sense?
Uh, to some degree, yes. I'm just sheerly talking about like looking at a net profit number with the tool you already have, right? And then saying like, well, we already have this tool. We're already utilizing it. You get these benefits. And if I were to want to make sure that I wasn't negative per year in like the quote unquote arbitrage game, I wouldn't be max funding it or max loaning it. And I would still be able to receive a positive net profit in my policy relative to the growth versus the loan interest. This is all I'm saying, and
Yeah, but
we're probably missing
yeah.
each other, but
Okay.
we're talking about probably two different things because
Yeah, but
I'm
that
just looking at it. And it's
this is the same language that a lot of people use that I dislike when it comes to infinite banking. They're almost making it sound like, hey, you can purchase that car because you're actually interest that you're earning on your entire policy is greater. Like, so they're almost combining the interest in your policy with a decision. And this is good that we're having this conversation because it just goes to show that there's different ways to view this and communicate this. But yeah,
yeah,
we can we
I'd also understand that, but then you're also now factoring in a whole nother cost that is like an expense from that perspective, because in theory, that is technically quote unquote correct. It's like, well, if I'm only borrowing 20 grand for my car, right? Well then, yeah, and I have 100 grand in the policy, that 20 grand is quote unquote costing me an interest rate. I'm getting positive profit in my policy. That is true. But then you're not factoring now in like this negative interest that's coming back for that you're actually a 6% over here, like negative wise. I'm just saying now, like, well, if we used it for an investment, you were using it in a equitable way for the policy relatively, and also a relative equitable way in the way that we should use it from borrowing. Versus if you use the full amount, like the full amount, your policy net profit will actually go down if you're using the max amount on both sides of the equation.
Yeah,
You're
I
not
hear what
always
you're
going to be
saying.
making, you're not always going to be taking max loans
Yeah,
in
but
when you
it
have the policy as well.
you're right. But what a lot of people say, going back to the $100,000 example, if you take a $10,000 loan, you can say on the macro sense, your policy earned X, and so it's earned more than what you had to pay in interest and all. But I, and that could be true when it comes to the policy, but that's not true when it comes to the activity. And that's where I think there's so much confusion is people combine the internal value of a policy and the external decision, and I think those should by definition be separated.
I agree with that.
Okay, we're gonna continue, but this is good, and we'll see. This is why there's a lot of questions about this, because even in our company, we have different ways of explaining things, which is a blessing in disguise. So when it comes to an internal rate of return, going back to my statement that I made, if my policy, if the only value that it did was earn 4%, let's just say, or 4.5%, and it cost me 6%, math would say it's dumb for me to take a loan. I should just withdraw that money. But if there's other benefits that I'm getting that increase that 4.5% to be greater, then you can say that there is actual beneficial arbitrage. And so if you take a look at just a policy, I've shown this a lot on the channel. This is just a $50,000 policy just to address the questions. This can work with $5,000 a year. This can work with $500,000 a year. We're just using 50,000 as like the unit price when it comes to this example. You can see that this is your cash value. This is the cash that you would actually have available to borrow against. And then this is the internal rate of return, which means this is the actual rate of return. So once it starts getting green, that's representing the growth on every single year, even including the red years. And so just to show, a friend of our channel, Todd Langford, Truth Concepts, you put $50,000 in for the next 30 years at 4.58%. You're going to get a future value of 3.2 million. You look at a life insurance policy, it's 3.2 million. It's the exact same number, which proves to you that this life insurance policy is growing at 4.58% every single year. So what we do is if we take all the benefits that you get in life insurance and we just say, okay, well, we're going to check the box and say this is a competitive growth. And so we're checking this, meaning like in this calculator, we're showing that this is getting 4.5%. And what we're going to do is we're going to compare versus the 30-year picture of a high yield savings account at 2.5%. And we're also going to look at the last 30 years bonds, which, let's say averaged 4.75%, just under 5%. So you can see that, right away, life insurance outgrows a savings account, but is a little under a bond. But the thing that we're going to try to do is we're going to try to factor in some of these other benefits and see if the rate of return increases if we factor some of these benefits. Because right now we can list off these benefits, but sometimes it's hard to quantify when it comes to like how these work. And so if you just factor in the fact that life insurance grows tax deferred and you can use it tax free, you can put some type of rate of return on that. Now, some people might not be paying any taxes at all. Well, this would be zero for you. Some people are in states that don't have state income tax. Well, that might be beneficial. Some people are in California and are paying 40 to 50% tax on their dollars. And so just like a savings account, you have to pay ordinary income tax. If we're comparing this to a savings account, essentially, and you're factoring in a 30% tax, now you need to earn 6.5% every single year, just when you factor in the tax rate. And when you include the cost of insurance, which, just to be simple, we're just including a 30-year term. So we're not including a permanent life insurance policy for life. We're just including a term insurance that drops off after 30 years. Now you have to earn over 7%. And if you include a fee, which probably you wouldn't include a fee if you're talking about a savings account. So if we just go back now on this list, if you just include taxes and a 1/10 of the insurance cost representing what you would pay for term, now you're getting an equivalent value of life insurance of over 7%. And we're not valuing all the other benefits here, the creditor protection, the contribution limits, the chronic and terminal illness rider. And so all these other things, now we're showing that this equivalent value could be closer to 8, maybe 9%. And I'm not saying that life insurance is getting you 7 to 9%. I'm just saying that it's a lot more valuable than what it shows on the illustration, because a lot of people are just comparing the cash rate of return and they're assuming that's the only benefit you get. Whereas actually life insurance, you get a lot of other benefits, including a permanent death benefit that will last your entire life and be super efficient when you pass on money. Dom, I want to get your take before I go into the borrowing aspect.
No, I think this is we were just talking for 10 minutes in regards to the policy, the loan rates, the functions, how it worked, arbitrage. And I think that this is the key piece to it all when it comes to just looking at life insurance relative to any other asset class. We can look at other asset classes for borrowing functionalities, such as a business, real estate, lines of credits, whatever we want to compare it to. But this specifically here, where the way that it operates with the external value and the internal values combined, is what makes this policy and the overfunded, quote unquote, whole life insurance policy so powerful. So yeah, I have really nothing else to add except like amen, and this is why we do what we do.
Love it. Okay, so now this is the slide, and full transparency. We got to improve our graphics at Better Wealth. So if you're a graphic designer and you're like, "Hey, Caleb, I love your concepts, but your slides look terrible," call me, text me, email me. We may have a side job for you.
You putting your cell phone number out there right now?
Yeah, yeah. No,
Text you.
email me. And 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 so, but what this picture represents is we have all the benefits that you get internally in your policy, plus for those of you that identify as entrepreneurial investors, now you have external activities as well that you could get, but they're not free. So let me break down what that means. So you have your internal benefits. And this is, you have your cash value, and the more you fund your policy, the greater your cash value is going to build, which is, think of it as available equity that you can borrow against. If you use like a house example, this cash value is available to borrow against, and you get all these benefits. So what happens is, if you want to take a loan, you can go to the insurance company or a third party lender, and what you can do is you use your cash value as collateral, meaning you can't loan more than what your cash value is, and usually you can get 95% of your cash value as collateral. So you can't loan dollar for dollar all the money that you have, but you can loan out majority of it. The insurance company is actually going to give you the loan. They're using your cash value as collateral, so your policy is actually, your money's staying in your policy, and you're getting all the benefits with your life insurance policy. And then you get an unstructured loan, and that unstructured loan means it's unstructured. You don't have to pay the interest if you don't want. It's recommended that you always at least pay the interest. Obviously, R. Nelson Nash would say not only do you pay the interest, but you're an honest banker. You pay yourself the same or more interest than you would pay somebody else, because you need to fund your bank. So regardless of what you do, it's an unstructured loan, and then you can buy anything you like with that. Now you'll see this dotted line, because this dotted line, a lot of times people combine internally and externally together. I think I'm just making up words. They take the internal benefit and they combine it with the external benefit and almost make it into one thing. And I think it's like, you're getting the internal benefit regardless of what you do. So you don't have to borrow, which is great. You can borrow, which is great. But you have to make sure that the activity that you borrow is actually worth it, and don't include the life insurance benefits into this equation, because you're already going to get it. So an example of this, Dom, would be like someone buys something at 0%, or let's just say someone buys something that's a negative, like they actually lose money, but they're able to say, well, I lost money over here, but my policy still did over well, so I actually washed myself out. And I'm like, okay, mathematically, you're not wrong. If you take a zoom out, you wash yourself out. But actually, if you didn't do that activity, you would be that much more ahead. And so, like, you took an L on one side, but your policy didn't take an L. Instead of combining that, separate that. That's what I'm trying to say on this, and I think that's where if when people practice infinite banking or talk about this, they just need to separate that. And so then the real question comes down to, when does it make sense for me to borrow? And the answer to that is when your activity is greater than the cost of borrowing, which is another way to say that is control cost. So banks do this all the time. When you go to a bank, and this slide needs maybe to be updated a little bit. When you go to the bank and get 1% for them to give you your money, and they loan it out to someone out at 4%, who would love to get 4% loan? I would. But they do that. Their ROI in this equation is actually 300%, because the bank is using your money. They're paying you 1%, which is an example. If you deposited $100, they're giving you $1. Thank you for your $100, Dom. I'm going to give you $1. They're going to loan your money out to me. I'm going to pay them $4. And over that 1 year, they made a 300% spread on that money, because they put $1 in, are getting 4 back, which is a 300%. We got to think of the same way when it comes to how our policies work. So if our loan's at 5% and we're going to buy an asset of 2%, the ROI is negative 60. Not great. You could do a wash, or you could actually earn greater. So if you hypothetically get a 12% investment, then your ROI is going to be on that activity is going to be greater, because it's costing you $5 and you're making 12. So you're taking the concept of banking, but the point that I'm making is, just because your policy is super, super efficient doesn't give you the free grace to, or mercy, or whatever the word I'm trying to use, to just go and make a dumb decision. They're two separate decisions, and when you combine them, they can be really powerful, because it unlocks your dollars doing more than one job for you. And so that's what I would say. And then the last thing I would say is, you might have a 7% opportunity. And in this equation, mathematically, even if you factor in risk, you feel really good about the 7% activity. And so the question could be, should I get a loan to take 7%? And for some of you watching this in this scenario, the answer should be yes. But others of you, if you put your money into a 7% opportunity, you're unable to say yes to a 12 or 15 or 20% opportunity. And that's where it's hard to factor in opportunity cost, is because some people want their money moving, but the definition of having their money tied up in deals potentially will make them not able to take advantage of other opportunities that come along. And so just because you're taking a loan against your cash value doesn't mean you're losing some liquidity, because you have less cash to actually loan against. And so anytime you say yes to a loan, you're not just taking on the cost, you're not just taking on the risk, you're also taking on the opportunity cost of saying yes to that decision. And there's my TED Talk, Dom. Most people have no idea where to start or how to really evaluate whole life insurance. That's why we've built The Vault. It's all of our best life insurance resources and educational tools all in one place, all for free. We have calculators, handbooks, crash course, deep dive videos on numbers. If you want to learn more, click the link in the description or tag comment below to unlock The Vault. All right, back to the video.
No, and I think that's why we are not a massive proponent of using your policy for liabilities, just from the sheer lost opportunity cost of what you're missing out on, right? In the book, Infinite Bank with Bureau Nelson Nash, he talks about using it for cars and other things like that. And I know people who practice infinite banking, that's what they preach. I'm not necessarily saying that like it's the worst financial strategy on the planet. I think somewhere along the way you could make sense of it depending on certain environments and certain rates and how you choose to practice it, etc. But what happens when you do borrow against your policy and you use up the cash value for that opportunity, quote unquote, your vehicle, you now miss out on opportunities to actually go build real wealth. Asset classes that can produce wealth, that have tax advantages, appreciation, cash flow, like all the things to having your dollars do more than one thing. Now we really only have our dollars doing one thing, which is essentially like paying back your car. So that's really the reasons why that we push, if we're wanting to, and then if you find the asset that's actually producing real cash flow, you could then take that asset to pay for your liability. So now you have both, right? You have the funneling of this cash flowing asset, appreciating, getting the tax advantages, growing. You have that there as a hard, like whatever the asset is, and then you still have your vehicle and you still have your policy. So this is where I think people sometimes think that we're this like negative infinite banking a lot of the times. I know there's obviously some marketing or some way we don't approve of the way that people speak about it, but I think at the end of the day, we just want to try to find the best way to help people grow, protect, and keep more of their wealth.
Yep. Well said. Well said. And hopefully this helps answers questions. And I would be very curious, and I would love to hear your thoughts in the comments. Like, how else can we say this, or what are other ways that we can say, or other examples we can use? Because understanding the math, understanding risk, and understanding opportunity cost are like the three factors that go into making a decision on should I take a loan against my policy.
Amen. Amen. Is this the time where we go into a drawing, or is
I
do
mean,
you, we,
I don't know if there's much to draw.
okay,
I could draw, but
amazing.
it would be the
But
same. It'd be the same
cool.
thing. So maybe we go into like real
We
life
don't.
examples. You know?
Yeah, yeah. I have one pulled up.
Yeah.
Just like
Let's.
what an
Yeah.
example could look like when you're like shifting through. Okay,
Okay.
so let me start by coming back full circle to the beginning of this episode, and I talked about we have a client who has opportunity funds, right? One from a line of credit from a business. And one from a line of credit from the policy. The original policy design that we did for them was $600,000 front load and then $50,000 per year going forth. Okay. So just can kind of keep that in mind. There's on both sides of the equation, there could be the opportunity to borrow on the line of credit or from the policy around like 500K. Okay. Now, the question then comes down to which line of credit should I use? Because you're going to come across this if you're somebody who's actively looking for opportunities. You may have a HELOC that's producing a specific loan amount. Loan rate. You may have, business. You may have your equities that you technically could borrow. There may be things that you have to compare against. What I'll start by saying is if all things are created equal, where the interest rates are exactly the same. So with the company that he's with right now, the interest is right around 6.5%. And then if the line of credit with the bank is also 6.5%, you are going to be better off using your line of credit from the life insurance policy first and foremost, because of what Caleb said earlier is it's unstructured. It gives you flexibility in case something happens, in case you have to wait an extra year, or they have to it falls apart. Whatever the situation is, you have the flexibility to pay it back at a different rate, specific amounts. You're not forced to do it. That's the first thing. Now, when you're looking at actual other rates, the odds of your life insurance policy being lower than all other things to borrow is likely very high. And that's one of the amazing things about life insurance specifically is that it goes off the Moody bond in a lot of ways when it comes to the loan rates. And it's always, I'm gonna say always, but it's usually a whole lot lower. If you go look at like equity line of credits and money that you want to go get in the marketplace, it's always like 1 or 2% cheaper. That's even if you go to a third party lender in instances that Caleb was talking about, where you could get like 95% from the quote unquote specialist for the bank. You can get 95%, but you're probably going to be paying an extra 1.5 extra basis points to get access to the ease of capital, to be able to document it for business purposes. So you could get interest write off so that you can have the benefits that come with using a lender in situations like that. So that's why another reason why I'm such a big advocate for life insurance. And so what we're going to do is I'm going to share my screen and we're just going to specifically pretend that we're going to use our policy for this opportunity, like the life insurance only, and that the other lines of credits that the client, has are not going to be the first option. And then that could be something later. If another opportunity come up and he's fully max loaned for this, then those things could be also things that could become at another point in time. So I'm a big proponent of just real estate in general. I think that, when we're looking at asset classes that have benefits, we talk about this all the time. Life insurance gives you dollars in multiple jobs. You could argue 15 to 50, depending on who you're talking about. You could be grasping for straws, but there's a lot. When you look at real estate, you can argue that there's probably 5 to maybe 7 different jobs that your dollars can get as well. And so I think when you can combine the two together, it makes it very attractive because now you have your dollars doing, 15 to 20 extra jobs between the two asset classes, and you can have velocity of money working extremely well for you. And so this is why they talk about that majority of the quote unquote millionaires that are actually created in the world are built off of using, real estate. And then you hear like, these are what the wealthy people do. They use life insurance because you have all these benefits and it's a line of credit, and then you can use them both together. All right. And so with that being said, that was my soapbox. You had yours. Now I use mine, and we'll go ahead and share my screen, and we'll talk about
This is
this.
Dom and my therapy session each week. We
Yeah, exactly. Amazing. Okay, so I have this opportunity here. Okay, this is a multifamily investment opportunity that's in Phoenix, Arizona, and here's essentially the projected returns and summaries. Now, again, everything that we're talking about here, this isn't investment advice. This is sheerly just demonstrative purposes for examples of like, should I or shouldn't I not use my policy to invest into something like this? If you first and foremost understand what you're looking at, you understand the terminologies and language, you vetted the people that have helped or are doing this with you, and you then have decided that this is a potential good opportunity, you now have to figure out mathematically, does it make sense for your policy, or is it better off to hold off and use your policy for something different? All right. So, first, you've got to start with how much available liquidity do you have? And this is why we are big advocates when we're starting policies. Like if you're starting a policy and you're at the age of like 50, 45, and you're like, hey, I want to put $10,000 a year into a policy. It's like, well, you can do that, but your first year, you're going to put in 10 grand and you're going to only have access to maybe 8 grand, which means that there's not a whole lot of opportunities available for you for probably another 5, 6, 7 years. And then when you get to that point, you now only have the bare minimum amounts to be able to invest into a lot of really great opportunities when it comes to other things that are outside of the market. And so most opportunities that I've seen in the real estate market, whether it's a syndications, whether it's funds, the minimums are usually around $50,000. Okay. So just kind of keep that in mind. And that's kind of why, if you're younger, I do think that putting money into something like this and you be able to put a lower amount is perfectly okay because you have more time on your side. You have more time to keep learning. You're just setting money aside into this opportunity fund to let it grow and compound. And then when you get a little bit older and you've done the research and you become more sophisticated, you now have these massive opportunity fund bucket to be able to borrow against to use for something like this that we may be talking about. So first, when we're looking at this, you can see that there's 3 different buckets of names on here. There's cash flow, there's growth class, and there's platinum class. This really, again, comes down to the amount of money that one would contribute to it. Usually when you're looking at these type of opportunities, the more money that you contribute, the more favorable that the terms will be when it comes to the total amount of returns that you're going to get. Okay, so when we're looking at the 50, 100, 250, you can look at the equity multiple, and the equity multiple is 2.5, 2.15, and 1.45. All it's essentially saying is the amount of dollars that I contribute, of that, what is the multiple that I'm getting back? So if I essentially contributed, $100,000, it's for easier math. I'm just gonna use this. If I contribute $100,000, I'll get $154,000 back. So I get the 54,000 on top of the 100 that I contributed. So that'd be like the total of the entire thing. 54% over the lifetime of the opportunity. Okay, that's not per year. Okay, so if you divide that by 5 years, you could see it's more closer to like 10-ish, 12-ish%. All right, so that's the first and foremost the thing to point out. Now, Kid, did you want to say something?
Nope.
No? Okay, amazing. Now, what we're going to do is we're going to think about this from a conceptual perspective of I have my life insurance policy. Okay, and I even have an example that I have pulled up here. Okay. I even have an example of a life insurance policy that we could use. Okay. We could have used the example that the client that we had is, say, $500,000 line of credit because he contributed $600,000, $50,000 a year. He has plenty of funds to use, but we could have used that. But I think it could also be easier to kind of see what this could look like as well, just from a sheer cash value perspective when we're designing a policy. If you're somebody that's like, hey, I have some extra cash flow, I want to be able to put it into something. Does this strategy make sense for myself? I want to start by saying that this strategy really only works if you have a large lump sum of money that is sitting around, or you have a consistent way of creating cash flow that allows you to keep contributing to this policy over a specific period of time. So I would say bare minimum about 7 years to contribute to something like this is really where, the line in the sand sticks. If you're like, hey, I have $50,000 and I can only do it for the first year, this strategy is not for you. You have to have a consistent way of income or cash flow from other investments, ways that you can save money. Like saving money is the key to the strategy. If you're able to do that, you have to think about other ways to increase income, decrease expenses, and start with that from a foundational perspective. Okay, so we're just going to pretend that we have contributed to our policy for 2 years, right? So you've started a policy, you've contributed 100 grand, you have a job that allows you to save a business that allows you to save 100 grand per year. Okay. So you put in 100 grand the first year and 100 grand the second year. Okay. Cumulative premium. You now have a line of credit for $176,000 to be able to utilize for an investment opportunity. And we've talked about specifically, like we think that if you're going to borrow and use this strategy, the delta on the other end needs to be more than what you're borrowing against, the control cost, right? That Caleb was mentioning. And so what we'd want to do is say, okay, I have $176,000 to be able to use for something. Should I now be able to use that for an opportunity like this? Well, you could say, okay, well, maybe I want to start small and maybe go with the 50,000 because it's 25%, 20% of the funds that I have available. Or maybe it's like, hey, like I trust these people. I really like the numbers. Maybe I want to go with $100,000 instead. We're going to use the $100,000 because I think from a math perspective, it'll just make a whole lot more sense. So currently, right now, the interest rates when it comes to life insurance policies, they're right around 6%. Okay. So we're going to go with the 6% control cost when it looks to using your life insurance policy. And then we have to then evaluate this deal and say, do I get a better delta? Do I get a better return than what my control cost actually is, and does it make sense for myself? And am I missing out on other opportunities by giving up this $100,000 to put into this? Because I know I'd be curious to ask Caleb, is like, hey, after we kind of look at this, is this something that you'd even want to consider? And I would imagine that Caleb would be like, no, probably not, because I value control so much more in a lot of ways. So when it comes to this, I think the part that's super important is the cash flow number, right? Because cash flow really at the end of the day is the thing that's going to drive home the ability for us to live the life that we want and we desire, right? We can have more cash flow, quote unquote, passive income that's above our expenses. That's when we know we have more options, more flexibility, more time freedom to do what we want when we want. And that's kind of like the end goal. I think sometimes starting early on, maybe cash flow isn't the most important thing because you need to create a bucket of money that's large enough to then convert that to cash flow at some point in time. Same thing with retirement, right? You build this entire bucket of money into the S&P or 401k, et cetera. Well, it doesn't do you no good if it's just a big bucket of money. You have to figure out a way to turn that to cash flow no matter what. I think earlier on, we can strive for maybe more bigger buckets of money to eventually shoot for cash flow later on. But I still think looking at the cash flow number is super important because if we have a loan charge on our policy at 6%, well, we have to make sure if we want to not have the rule that we talked about of it being a good quote unquote opportunity, that we can at least bare minimum pay off the loan interest to our policy to make this thing work in a way that makes the most sense. And so I think even from an easy perspective, I can obviously pull up a calculator and be like, hey, if I take a $100,000 loan and I essentially, times by 0.06, I'm going to get $6,000. Obviously, so this is my loan interest charge, okay, that I'm on my policy. So this here, talking about up here, every year if I have, I don't know where my calculator went, every year or the first year when I borrow $100,000, the insurance company is going to charge me 6% to be able to utilize that funds. Okay. So if it's out for 365 days, you're going to get 6% charge. You essentially have a $6,000 expense that goes to that. Now, If I have an investment where I can borrow against it and get something that's at a greater than $6,000, in this instance, I get 8%. Okay, so you could obviously do the math. The math is pretty simple. I put in $100,000 to this investment. This investment gives me 8% back. That's going to now give me $8,000. So then my delta at this point in time is 2,000. So what makes a lot of sense is to take that 6 grand, okay, take that and pay off your loan interest every single year, okay? Then what you have to make sure, again, I talked about at the beginning, is you have cash flow from other places to be able to continue to do this strategy. So the following year, year 3, you would then put in another $100,000, okay? Your net cash value would then grow to $277,000. Now you subtract probably about $100,000 of loan availability, right? Your cash value is still 277, but your actual line of credit that you can utilize is probably around 177 because your $100,000 is still inside of this opportunity, right? That $2,000 you could do whatever you want with. You could save it. You can go invest in a different asset class. You can go on a cool vacation. Like that's the cool part is that when you find an opportunity, your 2,000 free flowing dollars between the growth on your investment, the 8% and the 6% in your policy charge, you now have the flexibility and freedom to make options and choices. And this is why it's so important that the investment that you're doing is actually going to create you a positive delta. And so then you do that same strategy every single year for 5 years. Okay. So year 1, you do the same thing. Boom. Pay it off. 8%. Pay it off. You're getting a $2,000 delta every single year. Okay. You're not contributing any more money to the policy. And then what happens at the end of this, you then get your return on the sale, $178,000. Okay. Then you take the delta between the 178, okay, which is just easy math, right? The 178, well, 178, and then you subtract the 100,000 that you put in. Now you have a $78,000 delta. So what you'd want to do is take that $100,000, pay off your full policy loan, and now you're at your full loanable amount that you can then go use for other opportunities. And now you have your $78,000 that you can go do again with some flexibility with whatever you want to do. You could use it to pay for your car for your mom. You could, put a down payment on a house. You could buy another investment property. You can go on a really cool vacation that you can go splurge with your entire family for generations. Like there's a lot of really cool things that you can do. And now every year you're putting in $100,000. You just imagine that you can do the same strategy every single year. You could add almost a new one to the repertoire. So after 7 years, you could be doing this with like 7 different properties, right? And you're doing the same strategy by taking the cash flow growth, paying off the interest. And when the sale of the property happens, you then go ahead and pay your policy loan. And you also probably want to save a little bit for taxes and things like that. And so this is how you think about would I or would I not use it is, do I have a long enough time horizon where I can, wait 5 years and be patient enough? Does my actual cash flow pay off my interest year after year? And if some of these answers are yes, and you find that at the end you'll be way better off from a wealth perspective than you were if you didn't do any of these, then the answer is like, this is probably something that should consider. And the more of these that you look at, and you're like, okay, well, I'm going to vet this person, this person, this person, this opportunity, this opportunity, this opportunity. You have options. That's the power behind it, right? It's the thing of, Nelson Nash's book is like the one with the gold makes the rules or something like that.
Mm-hmm.
It's like, well, if you have this line of credit of your life insurance policy, you make the rules because you now have funds, you now have an opportunity, you now have decisions you can make. You don't have to say yes to the first thing, and you can make better decisions clearly because you have this opportunity fund to think through. So that's just on a simplistic basis that I just wanted to share and talk about of like how to kind of think through should or should you not make some of these opportunities for yourself. Caleb, I'd love to hear from you if this is something that you would either consider or if there needs to be more from a return. Because,
Yeah, no,
from a year
I mean,
perspective, it's 18, 21, when
yeah,
you're
I
looking
mean,
at the
I
cash
think
flow
the
and the
one on
return.
the bottom, if it was vetted from a risk standpoint, which we all know that syndications have kind of gone through the ringer. But yeah, I mean, 21% IRR is a pretty great return. And so it just would factor into the risk. I would say that from an opportunity cost standpoint, I'd be totally fine tying up money if I was confident that I could get that type of rate of return. But that the big asterisk is real estate
Huge.
syndications don't always perform that way. And so that's like the $1 million question when it comes to any type of investing is do they have a good track record and what's the likelihood of success? But yeah, I think that's a great it's a great way to explain, just like, in just using a calculator, how you go about this. And I want to just ask a question, Dom. Obviously, we're talking a lot about entrepreneurs, but for someone who's a W-2 employee, what is does anything change? Because the way it really nothing changes on my end, because it's like you got to save your money somewhere and you got to invest somewhere. So depending on how you make your money is not like, some people make their money by running businesses, some people make their money by, working as leaders or like within businesses. What you do with that money, uh, is your choice, and you can still be an entrepreneurial investor if you're a W-2. And actually, some of our best clients are high W-2. They have stability when it comes to their income, and then they invest using the entrepreneurial framework. And they actually get best of both worlds, because a lot of times entrepreneurs are going up and down with income. They're creating stability, but instead of investing in typical ways, they're investing like entrepreneurs. But that is a question that we get often, because a lot of people say like, well, I'm not an entrepreneur, and so they almost like dismiss the things that we're talking about because they think it's only applies to entrepreneurs.
Yeah, no, it's a great question. And I think that when it comes to real wealth building and financial freedom, there's not a very high likelihood that you're ever going to do that sheerly just off of your W-2 income. There's going to have to be a way where you're going to need equity in a company or upside, for something relative to like the ownership of a business, right? So if you're a W-2, it's going to be hard to achieve some of that same mindset or same abilities to like build real wealth. And so the only way to do that is to go invest into assets. And I think that this is an incredible, incredible tool for a W-2 individual, because they get to not have to think about the day to day of running businesses, and they just focus on their job. And then they have this line of credit that every single year they can just focus on allowing this thing to compound and grow. And then whenever the opportunity presents itself to borrow, to use for an opportunity, they have that ability. So an entrepreneur may use it for their business, right? To invest into marketing, into people, into growth. Like that's great. But most W-2 people, if they're looking at true wealth building, they would use this for buying assets like this. So I actually think the example that I just showed is actually way more beneficial for a W-2 employee than actually an entrepreneur, because the entrepreneur may want to go use their funds for business, while the W-2 employee,
Yeah.
they may want to use it for this because they don't have the time and energy and headspace to think about, investing, or they don't have the way to go be the full-time real estate investor, because that's a lot of work. Like that's a full-time job in itself, right? When you're the GP of deals, you're vetting, finding, doing the underwriting, networking, making sure everything's going well, raising the money. But when you're the LP, the limited partner, where you're just investing the funds, you just have to probably spend an entire day vetting the people, the opportunity, looking at the track records. And that's why I think that this strategy is actually even better for a W-2 person when we're looking at investing into opportunities like this.
Well said. Well said. Anything else you want to say before we dive into the Q&A?
No, I think that was 53 minutes of us talking about
Yeah.
loans and life insurance. It doesn't get much sexier than
More
that.
exciting
So,
than that,
yeah, exactly.
Why that's where we're the fastest growing life insurance show on the planet right now. We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply. Back to the video. Let's talk about. I'll take the first comment. This is Caleb. I'll take the first comment because it says my name. Hey, by the way, if you want me to answer questions, just say my name. Caleb, I'm unable to get a policy for my son because his incredible fear of needles. You said that there's creative ways to get around this. Can you talk about that? The short answer is, if your son is under 18, all insurance companies that do permanent life insurance policies don't require needles. And if your son's over 18, there are certain insurance companies out there that we can go through underwriting without blood and urine. And so that would be, and I just want for the record, competitive companies out there like Penn Mutual that you can get a really, really solid policy and potentially not have to do blood and needle. So that would
Yeah.
be my answer to that. And I think if I remember correctly, I shot you a comment, and you can always email us, and we would be more than happy to answer your individual questions. Sometimes it's hard to answer questions just because people are asking like, what should I do? And so we can speak generally, but the only way that we can really speak to your situation is if you reach out to our amazing team.
Yeah. The cool part also about the space is it's becoming more competitive around these insurance companies. And there is, Penn Mutual really has the quote unquote initial gold standard for underwriting without a needle, at least with the companies that we use. And every company is realizing like they need to do so as well if they're wanting to be competitive. So, four of the companies that we use, Lafayette Life now, Guardian, and Mass Mutual, all allow fluidless, needleless underwriting in a lot of instances. Like there's certain parameters. So yeah, it's cool. Amazing. All right, next question. Um, $500 per month for life insurance for a child? Question mark. When they grow up, they have to borrow the money they put in it to pay for college just to have to still pay the money back. Doesn't make sense. Amazing. Well, if you're being serious about this statement, then I want to say I'm very empathetic to where at first it doesn't make a lot of sense. If you're being sarcastic, if it doesn't make sense, then this isn't for you. Now, if you're like genuinely curious and you want to learn and you're trying to figure out like, well, how does this make sense? Well, you have to realize that this strategy has a borrowing function around it to allow you to get the tax advantages first and foremost. Okay, the policy will grow tax deferred. You could access the money tax free. And then this is what allows you to get the uninterrupted compounding for the rest of the policy's life as well. All right. And so that's the part about like I have to borrow the money to utilize it. You actually technically do not have to borrow the money either when you're utilizing this policy. You actually could take a withdrawal, and then everything above your basis would then be taxable at that point in time. You could also take a withdrawal up to the basis and then loan everything, so you don't pay taxes at all. So there are ways to avoid having to borrow if you want to, but the power behind this is the uninterrupted compounding that goes on where you're collateralizing it just like a HELOC, just like other things that allow you to get the tax benefits and grow indefinitely. Now, for college purposes, I do, and I'm sure Caleb, you would agree that relative to something like a 529 plan, this is an incredible strategy because it gives you options. It gives you flexibility. Your kid may not want to go to college when, depending how old they are, if they're 3, 15 years from now, you have no idea what they're going to want to be, who they're going to become, and you also have no idea what the world's going to look like, right? So that's something to consider. And then with 529, you have to use it for, they're getting a little bit more broad into, you could use it for other things, but mainly you have to use it for, college and college planning and things like that. And then for us, we just believe that, having a death benefit on your children while they have the flexibility and options for the future just creates a better tool than something else like 529.
Yep. I would say we just did a whole episode on borrowing, so you can go rewind and watch. And you're right, it doesn't make sense if you don't value all the other benefits that you get with life insurance. The question is, with all the other benefits of life insurance, is that more valuable than having a loan feature? If the answer is no, then don't do it. If the answer is yes, then it makes a lot of sense. Next question. I'll take this one. I didn't know about convertible term. Can a convertible term policy be written to become an IBC-friendly whole life insurance policy? Short answer is maybe. There are certain companies that have competitive convertible term that give you the optionality to convert using any type of designs. A lot of insurance companies do convertible term, but they have restrictions on how you can convert them and like what type of policy you can design with that. And so to answer your question is you maybe, and if you work with companies like ours, for sure, yes. Like we can get you a competitive term insurance policy that give you the convertible option to do something very competitive on the back end. And so that's a great question, and it's a very thoughtful question. So thank you for asking.
Amazing. All right. Next question. Is there an argument to first create a PUA whole life first as your foundation, then wait for a clear downturn in the market before considering additional IUL, VUL? First and foremost, I want to say uh, TY/QJ6WS. You are a very sophisticated individual, nonetheless. For you to even understand whole life, the way that it's functioned, and then to even consider, should I kind of quote unquote time the market for IUL, VUL, is I can tell that you're a very sophisticated individual, the way that you're thinking and being creative. Um, I would say that why not consider that first and foremost? I don't think that that's necessarily like the wrong strategy. I do think that if you're looking at it from a death benefit perspective, then I think that you may be just missing out on the death benefit from the VUL, IUL, etc. And now you have to get very clear at the end of the day on why you'd even want an IUL or VUL. Because when you're looking at borrowing functionalities, we do believe that whole life is going to be the better strategy because of the fees, the upfront things that come with it, and the risk relative to the whole life. But if you're wanting to look at this maybe like long-term planning, and you're wanting to look at this for a sheer death benefit play, and you want to have it in a wrapper that has some tax advantages that come even more with like a VUL, etc., then I think that we are probably getting close to seeing something relatively where the market may, not investment advice, turn. So considering something in the near term for this strategy, if you know somebody who's qualified, who's educated, who's a pro expert in these strategies, is something to definitely consider. That's a tough question to answer at the end of the day, but I don't think that you're in the wrong for thinking of it that way, because you have a down year, the odds of you getting another down year is very small. I think 2 down years in a row is probably the max that you really have seen in history. So you kind of just avoid some of the risks in the early years with something like that. So yeah, I think it's creative thinking.
Yeah, I think it's creative thinking, and I would also just caution against thinking about life insurance as an investment. I don't know if that compounds well in the end. And so you're taking an investment, dollar cost averaging, buying dips concept, applying it to insurance, which is creative. But I would just say that I would caution that mentality, because I think 20, 30 years out, you may or may not be happy with the overall long-term performance of that asset versus actually investing directly. So, but great question, and appreciate your answer to that, Dom. All right, this next question is, why does whole life require so much mindset shifting, analogies, hypotheticals, false equivalences? Just make sense of owning it, dot, dot, dot. You guys are geniuses in your own mind. Um, yeah, I mean, here's what I would say. I think another way to ask this question would be, why do you have to come up with so many, again, analogies or hypotheticals when explaining something? And the answer to that is, this is nothing new. I mean, you go back into history and you look at Jesus himself. He talked in parables. He talked about it in examples. Some of the best communicators in the world use stories and analogies and word pictures. And so we have plenty of videos that are showing directly math, how numbers work. And those are great. I actually prefer looking just at the numbers. But there are other people that learn differently. And so what we're trying to do is we're trying to get into a space where life insurance is very misunderstood. It's very missold. It's very overhyped, and in some cases over trashed. And so you're getting this thing that's really on one side overhyped and on another side trashed, and I would say not rightfully. And so you find us in the middle that are trying to show math examples, but then we also know that math doesn't always create light bulb moments. Sometimes you have to create the philosophy and hypotheticals to bridge the gap. And so that would be my answer to that. I know that this person's probably asking it in a probably not a sincere way, but I appreciate everyone that takes time to comment and to watch our videos, and we are always getting better, and that's what I'm grateful for. So if there are better ways that we can communicate or better examples, I would love if you're sincere, I would love to hear what you would do, and we might apply that and make our videos better. So that's what I would say as it relates to that comment.
Amazing. Well said, sir. Well said. Love your genuine tonality. Love it. All right, last question. So we know the growth on the cash value within the life insurance is tax free, but is the growth within the PDF also tax free before it hits the life insurance policy? So I'm going to break this question down into a couple folds. So first and foremost, so we know the growth on the cash value within the life insurance is tax free. So I'm going to start there. Technically, inside of a life insurance contract, your cash value does not grow tax free. It actually grows tax deferred. We are able to access it tax free though because of the policy loan function. So I just want to just share that and just be clear. I think mentally, for the way that it feels, it kind of feels like it's growing tax free anyway. So if it's easier for you to understand that, I'm very empathetic to that. So there's the first part. But is the growth within the PDF also tax free? So for you that don't know what a PDF stands for, it stands for Premium Deposit Fund. Also tax free before it hits the life insurance policy. So a premium deposit fund, for individuals that don't know, is essentially taking a large bucket of money and setting it into this side account with the insurance company. The insurance company is going to grow at a specific rate that's going to credit that, and then that deposit fund, that side account, will then pay your premium payments over a specific period of time. Alden Armstrong, who's one of our wealth coaches, unbelievable. You guys have seen him probably on the show. He just did an episode on premium deposit funds with New York Life and how New York Life has this 12% first year, premium deposit fund to get people enticed to want to put money in store with them to get policies, et cetera, et cetera. So the question is as that grows, is that tax-free and work the same with life insurance policy? Is the answer is no, that any growth that happens on your premium deposit fund, you do have to pay taxes on that at ordinary income. So just keep that in mind, is that it's not all a quote unquote tax-free strategy. If you do use something like that, you do have to pay taxes on the growth within it. Okay. And I think that actually wraps us up with our last Q&A. An hour and 6 minutes of talking about life insurance. Caleb, we did it again.
Never
We
gets
did
old.
it
Never
again.
gets old.
Never gets old.
Appreciate the conversation. Appreciate the questions, and I look forward to reading more of your comments because definitely think we can do a better job as a profession and industry answering this question about when does it make sense to borrow, and hopefully we can play a role in helping that conversation further.
So good. And we'll always try to say at the end, from a CTA perspective, if you want somebody to design your policy with high liquidity cash value and you just want life insurance in general, we do believe that we are some of the best in the entire space. So we have a team of experts, both on the underwriting and on the life insurance design perspective, that if you want to have a conversation, if this makes sense for you, go ahead and click the links below and we'll be more than happy to serve you. And until next time, you guys have an amazing day, and we'll talk soon.